Good morning, everybody. Welcome to today's 1 million by 1 million strategy roundtable for entrepreneurs. 1M, as you know, is the first and only global virtual accelerator in the world. Our mission is to help 1 million entrepreneurs reach $1 million and beyond in annual revenue. And in support of that mission, we've been doing these roundtables, these free mentoring roundtables for a very, very long time. So this is the 542nd session. And we started doing these in the fall of 2008. So it predates this format predates the 1M1M program in its full scope currently, which was launched in 2010. So every single roundtable recording is available on our YouTube channel, 1M1M Roundtables. Our Twitter handles are at 1M1M and at Stromana. You're very welcome to follow. We always publish interesting stuff. And hashtag is 1M1M for today's live tweeting. Today, we are in a bit of a crunch. We've had some technical issues, and I have something else as well. But we have one piece of scheduled programming that we will make sure we get through, and we'll get through Q&A. We will not do entrepreneur pitches today. So these are the call-in instructions. It is a roundtable. It's not a broadcast, so you're most welcome to participate. I will put these up a little bit later, but the public chat is open, so you can introduce yourselves. You can tell us where you're joining from, what project you're working on, what brings you here, etc. And you can also ask questions while we do the scheduled programming. It's with great pleasure that I welcome today Warren Weiss. Warren's very well known in the industry as Bunny Weiss. That's his nickname. I've known him for a very long time, and he was a founder at I was a general partner at Foundation Capital for many, many years, which is where I got to know him. But actually, our families go back a long time. My husband, Dominique, and Bunny worked together at Next under Steve Jobs and lived a very exciting time in our industry. And more recently, Bunny has started his own fund, WestWave Capital. Bunny, welcome to the show.
Great, Stromana. Thanks for having me. It's an honor to be back with you again, and certainly known each other a long time, and great respect for you and what you're doing with your audience.
Well, and you have very recently invested in one of the 1M1M companies, so it's
I have.
You've had a chance to work together a bit recently. Yeah.
Yes, yes. I wanted to thank you for the opportunity to get introduced to Fullcast.io, which is in the enterprise sales planning arena. We're very excited to be an investor, and we appreciate the referral that you gave us.
And I thought you would be the perfect investor for that company because of your background in sales management. And it's, you know, one of the issues that we faced while we were funding that company is that everybody in the industry asked, what is the AI angle to this company? I'm like, this is not an AI company. It's a workflow and automation company.
Yeah, if you can't deploy your sales force effectively, I think you're in a lot of trouble in today's technology world.
Yeah. So let's start with a little bit of what you are thinking about doing with WestWave Capital. It's obviously a new project that you're doing. So what's your investment thesis? What's the fund size? What do you want to invest in going forward?
Yeah, no, that's great. Yeah, great. Thanks. So WestWave Capital really is a 2018 was our first fund. Fund one was a $33 million fund. We're in the micro VC asset class category. That's kind of funds designated to be under 100 million. The focus of the fund is enterprise only, SaaS applications, security, cloud infrastructure and edge computing, IoT and 5G. And we have some theses around artificial intelligence and what it should be used for around engineering productivity. And those are the immediate thesis. We've invested in 41 companies. We've had 7 exits to date. We're soon to have a few more there. So the fund's off to a good start, and we're raising our fund 2, which I can't talk about publicly, but it'll be a little bit larger.
So in Fund 1, what is the check size that you've been writing?
Yeah, we started initially with $300,000 checks. We're now up to $500,000. And in our next fund, we'll be writing checks up to $2 million as we'll be taking a little bit more ownership. First fund was really agnostic about ownership. We really wanted to get our brand out there and work with great firms. We're very strategic in how we think about who we do our seed, pre-seed, and Series A projects with. I've been at this a long time. The data's overwhelming. Who you invest with really matters.
And what do you like to see before you write a $300,000, $500,000 check, or what you're going to be doing going forward? What level of validation are you looking to see, especially in an enterprise play? What kind of what stage are we talking about?
Yeah, you know,
by way of metrics.
It's really situation dependent, but you know, I would say the data that we've collected, about 40% of our projects had some customer revenue at a few customers. I wouldn't confuse that with them having really product market fit, but they've been able to demonstrate kind of beyond an MVP that they have a product that actually works. We've also done many projects that have no revenue and don't even have a product yet. So, you know, our thesis is in the micro VC asset class space. The initial rounds are between 1 million and 3 million, and we partner with angels and other micro VCs, and sometimes with Series A firms. But lately, it's unusual that will happen.
Yeah,
so,
the micro VC asset class is completely segmented.
Yes. Yes, and so, you know, all the Series A and all the other, you know, alphabet soups that you wind up getting funded have also moved up quite a bit in terms of the size of each of those rounds.
And geography, money, are you investing all through the United States, all over the West Coast? What are you thinking?
Yeah, I would say that about 70% of our projects are here in the Valley still. Okay. Although, you know, they're highly distributed teams these days with, you know, kind of work from anywhere, especially during the pandemic. We do have a couple projects in Europe and none in Asia. I think that would be harder for us to do, although we're actually talking with one now. The requirement for us, if it's outside the U.S., that eventually they are going to move to the U.S., and that we have a partner, a venture partner that's local on the ground to assist the firm. And, you know, we're very strict about that because we want to have good co-investors. Okay.
Now, you started off by saying you've already had 7 exits within 3 years, 2.5, 3 years. So talk to me a little bit more about the exits and, you know, what are the circumstances of these? That's unusual, right? For a small micro VC fund to have 7 exits within a 3-year period sounds very unusual. So could you elaborate on that?
Yes. So, you know, one of the areas that we're in is security. You know, it's a bit of a cat and mouse game in terms of trying to stay ahead of the bad people, and the security business, you know, the funding and the growth of the larger enterprise security companies is, you know, they're hungry for growth. And so they're looking for acquisitions that can be tuck-ins. And for us, that, you know, that's represented a 30% IRR, even though they've been small dollar amounts. And so we really focus on funding great engineering teams, people that know how to build world-class products. So if they don't find product market fit, then, you know, they've not burned through very much money, and they have very talented engineers, and they have some customers, and therefore it's been pretty easy for us to exit those companies. And we use about half of that money to recycle, to go in other 10x style investments. So it's mostly been in the security-related field where we've seen these exits happen quicker.
Very interesting. You know, we have had the same experience. We sold a company called Adia from our portfolio to Qualys. You know, this is before Philippe Couture passed away, actually a couple of years ago, and I knew Philippe very well. And we had exactly the same issues, that they were finding customers, but not quite high velocity product market fit. So I introduced them to Philip, and Philip and Sumit basically acquired the company. So is everybody seeing this a mode of investment in cybersecurity?
Yeah, I think, the companies that are focused on enterprise are seeing this kind of activity in enterprise security for sure. It's very hard to build a standalone independent security company. And you've seen SentinelOne do it recently, but there are hundreds of small acquisitions that can really work for the entire ecosystem. Entrepreneurs have made good money at that, and they found a good home for their employees and customers, and they get to see their product live on and thrive and provide immediate impact to these larger security partners.
Bunny, do you feel comfortable talking about the economics of such deals? How much money goes in? It's just a thumb rule. How much money goes in and how much money comes out?
Yeah, what we try to work really hard with is the folks, whether we're doing kind of a pre-seed up to $3 million or a full seed up to $5 million, is, you've got to hit certain milestones. If you don't get to $1 million in ARR with raising that kind of money with a viable product and have an efficient, way you go to market where you make 70 to 80% gross margin, then you really don't have a business that deserves to get Series A funding. We really believe it should be that, structured. And so in those cases, let's just say, Shamana, that $3 to $5 million goes in. And I would say as low as 15 million to 50 million would come out in terms of an exit, all within 3 years. And so while they're not large numbers, it's the right thing to happen in the marketplace. And like I say, if some of those, don't meet those requirements, we generally have worked very closely with the entrepreneurs because it's in their best interest to sell. If they go get a Series A, raise 20 to 25 million at most recently, our Series A's have been done. We've done 29 follow-on rounds at 85 post. Then, you're going to really struggle if you take that money from a dilution standpoint and then don't miss your numbers. And the Series B then become draconian. I mean, that's where they're really weeded out if they don't hit those Series A milestones to go from kind of 3 million to 10 million and then 10 million to 30 million. So we kind of lay that all out with the founders up front. And so it's not a surprise, and everyone's working towards a similar goal versus not being clear about what the goals and objectives are with the funding. Because venture capital money is expensive, especially at the earliest stages. It can be highly dilutive. So, I was a long-time entrepreneur, and I always try to watch out for the founders because I want them to understand, this is very expensive money, and you've got some very aggressive goals you need to hit if you want to be a significant winner and go out and build an independent company.
Yeah. We have very aggressively developed a whole track within our program. We have a big education effort, right? And we are scaling that education effort right now with some very interesting partnerships, including with Udemy. The theme that we have developed around this topic is bootstrapping to exit. And by bootstrapping, I don't only mean companies that are working without any outside capital. I also mean companies that are working in a capital efficient way with small amounts of capital. But it's the same philosophy that you do things very capital efficiently and get to certain milestones such that without making the exit price too high, you can actually exit and have a good outcome for everybody around the table.
Right.
So you've answered one of the questions that I had in my original talking points that I had shared with you, is that are you chasing unicorns only, or are you also open to the smaller exit schemes? That's where we start.
They have this term mini-corns now. So we have a number of companies that have been named mini-corns, which could become future unicorns. I don't really pay any attention to that, Sherman. I've been doing this a long time, and you're rewarded, by your execution, not by what you say. And that requires you to get customers, keep customers, grow them efficiently. And, that's what we're looking for. And, at the stage we're at, you're going to have a fairly high mortality rate. And if you focus on building great products, then, we've been very fortunate. We haven't had a single loss in the portfolio in 3 years. I can't remember a time in I've been an venture investor for 21 years now. I can't remember a time in history that's ever happened. I don't know if that means we're actually doing a really good job, or it's the sign of the times because there's so much capital available, both strategically and from a venture standpoint.
Well, I think the number of companies that have critical mass and can acquire is much, much higher now than what it was even 10 years ago, right? I mean, look at the crop of SaaS companies. There are so many public SaaS companies, so many SaaS companies that are now owned by private equity, the Thoma Bravos and the Vista Equity Partners that are now trying to do roll-ups and blah, blah, blah. So there are many more exit opportunities than there ever was earlier in the venture capital history.
Yeah, no, that's a great point. That's a very important point. The private equity late-stage buyout firms like the Thoma Bravos that you named have been extremely aggressive and offer valuations in many cases are close to what strategics used to offer you. And so you have a bidding war, and now you've got more players in the pool that want to acquire. So when you're working with these, bankers, they're able to get a much larger set of firms interested, both strategics and buyout firms, because everybody, the market caps are pretty healthy in all these spaces that we play in today, and they've got to keep growing these companies aggressively. Otherwise, they can't continue to be a public company or get public.
So what is your analysis of the other channels of enterprise computing today? We've talked extensively about cybersecurity. We've talked about bootstrapping to exit or capital efficient to exit early on. In the context of cybersecurity, do you see that applying to the other avenues of enterprise software?
Yeah, for sure. We have a thesis around each one of our current investment strategies and analytics. We believe the world needs to look more like Google search, rather than learning SQL and mundane languages to try to extract data. There's so much data available today that you should be able to use neural networks and machine learning, artificial intelligence technology to abstract that so that the end user can actually ask an English question versus write a report. And in the area of multi-cloud, years ago, I funded a company called Clicker that was bought by Cisco, and it was one of the first multi-cloud management companies. I remember talking to my partners at the time saying, well, Amazon's going to own the cloud. And I said, well, it never works that way in the IT industry. So in the multi-cloud world, you kind of got the big three with Google, Microsoft, and Amazon. So every part of the stack, database, networks, analytics, security, all those have to be rebuilt for a multi-cloud environment, observability. And you see lots of winners in that space doing multi-cloud kind of management with breadth and depth that Kubernetes brought to market and the ability to orchestrate between clouds. It's offered lots of startups a great way to be vendor, avoid that traditional vendor lock-in. So lots of great things going on there. And then, one other space, everybody talks about artificial intelligence. Many times in the early days of these companies, they don't really have any artificial intelligence because they don't have the data that they need to build the models on to create supervised or unsupervised learning models. So one area that we focus on, we believe that engineering, quality assurance, and building applications, building UI and UX can be done mostly by machine learning versus hand coding traditional systems. So we have a few companies that are in that space that are trying to take care of 80% of this using machine learning and fixing bugs with bots and things like that. So, and then the SaaS space, remains, very interesting. There's just so much disruption that new trillion-dollar industries are, being created. You see, banks becoming e-banks, insurance companies becoming insurance, and you pick every industry, supply chain, they're getting entirely reinvented. And then one more area that's interesting is blockchain. We don't do any cryptocurrency, but in the enterprise blockchain space, we've seen some terrific use around supply chain and security around anti-money laundering, combined with database technology to offer very efficient, highly secure SaaS applications. So we're seeing a real resurgence in that area.
So I have a couple of thoughts listening to you. One is all these areas we are talking about, whether it's multi-cloud, whether it's AI, machine learning, blockchain, all of these, and also the vertical SaaS, each one of these are talent war scenarios. They are highly specialized areas. There's not like abundance of people who have great expertise. And that's also another driver, I think, for these acquisition scenarios, because the larger companies are also trying to hire talent. So one of the ways they hire talent is by acquiring smaller companies. So that also creates a conducive environment for these smaller exits.
Mm-hmm. Mm-hmm. Yeah, the whole workforce has been massively disrupted by the pandemic, and it's brought to light new issues about how people really want to work and where they can work from. And so those distributed nature in which you engage and hire and onboard and train and, with employees has become much more strategic. We have made a couple of investments in that HR related space, and, it's HR. While sometimes it's difficult to sell because human resource executives, CHROs, have lots of business problems, but not lots of power in companies. But they are being more and more empowered to, keep these talented workers in the company. The amount of activity I see at the board to ensure that we're actually engaged with employees in the most efficient way is more than I've ever seen before.
Yeah, I mean, I'm hearing it from everybody is that the talent war is just insane. Just because there's so many companies out there, right? There's so many small companies and there's so many mid-sized, large companies. Everybody needs a finite pool of talent, and the output of new, sufficiently trained people is not at that level. Which actually, were you going to add to that?
Yeah, just one other thing I would mention. I think the workforce of the future has to be thought about in terms of both human and, both robots and drones, because work augmentation it's taken place by those. We just funded an insurance company that just does insurance on robots and drones, because there's so many of them being used. And, there's a great fear amongst factory workers that robots would replace them completely, but exactly the opposite is happening. They're allowed to do the mundane tasks that it's hard to hire and keep people for, where they get hurt all the time. And workers can, grow into new jobs that are more strategic from a supply chain or manufacturing or customer service standpoint. I think everywhere all of us go today around the United States and even around the world, everyone's trying to hire people. So I think the workforce of the future has to consider those other options as part of the task to be able to, have enough talent to run these businesses and grow.
And facilitating all that, there are startup opportunities that are growing in the HR area as well. The other one that I think you would resonate with and have thoughts on, Bunny, is what we experienced with Fullcast.io. These guys, the Fullcast.io team, came out of Salesforce.com's sales ops organization. They were very, very deeply knowledgeable about sales ops. And that's what they built their whole sales management system around. It was not AI, it was not machine learning, it was really deep domain knowledge in managing sales operations. Now, this team exists in many other functional areas, many other vertical domain areas where there are deep domain knowledge that can be programmatically automated and software built around. I imagine you're seeing this in many other industry sectors, right?
Yeah, yes, we are. You know, the Fullcast team is quite interesting because they understand the complexities of multi-channel global sales planning and territory management and doing it efficiently. And it's amazing how long it takes a large company to reassign new territories every year, every quarter, new product line, acquisitions, merge them in. And, you know, everybody says, well, can't Salesforce do that? And the answer is no. The second piece I would say is sales operations and marketing operations are very tied in with this area that's growing fast called revenue operations, because they're integral to understanding both the, you know, revenue opportunity and the cost to service that revenue. And, you know, SaaS metrics are so focused on trying to understand the CAC ratios, what it really takes to, you know, find, deliver, sell a customer, that those two areas now, which you would think, you know, time would have enough automation by now, are just large white spaces available to.
Yeah. That was surprising to me when we started working on Fullcast.io, is how wide open that area still is, and that tells me that there are many industry segments which are far more backward. I mean, we are talking Fullcast.io is selling to, you know, cutting-edge SaaS companies and finding white space. So now if you look in manufacturing, if you look in logistics, and if you look in, you know, industry segments that are not as, you know, as advanced, there's a ton of workflow white space. And it doesn't need to be AI. I mean, eventually you introduce AI and you will find opportunities to introduce AI, but there is just bread and butter workflow automation still wide open.
Yeah. No, it's amazing. The more transparent that the data on, you know, who's doing what in your companies and how customers buy, there's more opportunity to really understand both business processes and mine data to make things more efficient in all these enterprises. They're still incredibly inefficient, most of these large enterprises.
Yes. Bunny, any thoughts on specifically opportunities that you have identified out there that you would look for a company to invest in, just so that our audience is aware of, you know, specific problem domains where you see possibilities?
Sure. There's this new concept, or fairly new concept, known as data stitching or application stitching, and these are things that fall like into customer service. We funded a company called Loops, where they're putting together data and application business processes to get new insight. For example, combining product management and engineering data with real customer service data, and really trying to intersect those two so you can understand, you know, what it is that the customer's actually asking for and what the responses have been. Because a lot of these applications reside in the cloud now, there's a whole new set of, I could kind of simplify it by saying middleware, but it's really new ways to integrate data between applications in real time, as well as create next generation set of analytics using AI. The whole data warehousing business that was done centrally by IT, and then you built business analytics off that, really is going to go through a complete transformation, because now with the kind of integration that's available and the kind of usability, ease of use, and the amount of data that you can collect and act on in real time, everything is speeding up in these enterprises, and you can no longer sit around and argue about whose data is right before you make a decision. You really need to get accurate information and be fully transparent behind it. So I think that whole analytics space we're very excited about. I think these next generation applications, SaaS applications where you can use multiple sets of information coming from many different transactional data sources, is another place that's super exciting. The whole shift left movement in security, to be able to pick up and build an application from scratch using security properly, that's an area known as cloud posture management, is a big growth area as well. And of course, we've been waiting for the, what used to be the industrial internet, then was clean tech. It's now, back in some forms of ESG and other things. The whole IoT connectivity is really starting to rapidly take off, and there's new applications and new security, and it's a very exciting space that, companies used to think about doing digital transformation in 10 or 20-year slots. If you don't do a full digital transformation and become a digital native company, you're going to be out of business. And so the pressure, on these large corporations through things like COVID actually showed all of the flaws of these companies that couldn't engage digitally or sell digitally. And that's really, really helping the startup world, because you've got to innovate very fast now to take advantage of those opportunities.
Well, the other great thing that has happened for startups selling to enterprises in COVID is that there are much bigger deals that are closing with no in-person interaction, and you must, with your background, you must appreciate that greatly.
Yeah, well, we're figuring out that this also involves Fullcast, because we ask our head of sales or our chief revenue officer and our marketing CMOs to really document since the beginning of COVID how the marketing and sales process has changed, and to not go back just because we could see people in person and do the same jobs the way we used to years ago. And what you're finding is a lot of customers are really enjoying that. I mean, they're enjoying the fact that they can engage digitally. There is some fatigue from time to time, but the SaaS applications need to be incredibly responsive to remote marketing, selling, and customer service. And many of the original Gen 1 SaaS, you look at something like Workday, it's 20 years old now. Salesforce is 20 years old. And there's, new ways in which to build these applications that are much more engaging, much rapid development cycles, and that's also provided startups great opportunities.
Very good. Great conversation, Bunny. I should let you go. I think you're in the car.
Yeah, no, I actually got back home. I apologize to your audience about, I tried to sign on, so I'm sorry I was late and sorry I couldn't see you in person, but thanks for the invite.
Most welcome. We'll talk again soon. Take care, and thanks for coming.
And best to dominate.
Bye. Take care.
Bye-bye.
Folks, very quickly, we're not doing entrepreneur pitches today. We will resume that shortly next time. I'm going to give you a quick overview of how to use 1M if you are here with a specific agenda of using the acceleration program. And I'll quickly take some questions before we adjourn. If you like what we do here, refer serious entrepreneurs to 1M. We do everything from, I'll take you through all the pieces. Go to 1Mby1M.com. Everything is there. It's one of the most comprehensively laid out sites you can find. The blog is terrific. We have people who have been following this blog for 10, 15 years. I started writing this blog at the beginning, in the spring of 2005. So it's been around for a long time. We have a very, very long readership. And then the book series called Entrepreneur Journeys was born out of the blog writings. We have been inviting people to be interviewed on the Entrepreneur Journeys series since 2006. So it's been 15 years of case study development. The books are all case study based, and you can definitely start your learning on that. These roundtables happen every week. We have, as I said, we have done over 500 roundtables. Now I think we're coming up to 200,000 people who have attended these programs. We are here most weeks. Plus, we do the full acceleration program, which is 1M1M Premium, which also uses roundtables as the project-based mentoring platform. So you get full, methodology guidance. We have a curriculum that we use to provide you with methodology guidance. And we do interactive coaching like this, in a session like this every week. So you can come talk to me every week if you're part of the premium program. We do help you with financing. Bunny has just funded one of our companies. We have a great network. So we do business development, we do media relations, we do investor relations, all of it through that network. And if you're in the premium program, you do have access to the network. Do the self-assessment on the website. It's free. It gives you the due diligence questions that investors are going to ask you. So make sure you can answer those questions. The Bootstrapping course on the blog is pinned to the top of the blog. It's a 1-hour course. It was commissioned originally by LinkedIn, but it's been taken by probably 250,000 or more people. It's a really, really great introduction to the philosophy and methodology of 1 million by 1 million. Another place where you can access 1M by 1M methodology is now on Udemy. If you go to Udemy and do a search on my name, you will find 25 courses, and we're adding to that collection. And you can easily start learning the 1M by 1M methodology. And a quick trick, on Udemy, they run promotions a lot. So you can get discounts, very, very deep discounts, 70% discounts, and you can acquire 10 courses for $100 and really get deeply into the 1M by 1M methodology through Udemy as well. Of course, we have 1M by 1M Basic. That's $99 a month, which gives you access to the whole 1M by 1M curriculum on a monthly subscription basis. That's another way you can accelerate your learning. Whichever way you choose, we are trying to give you all different price points, all levels of democratization access. Anyway, go to the website, dig around, see, what looks good to you. We have published enormously to, give you full access to FAQs, video FAQs. What does it take to raise money through 1M by 1M? What does the curriculum consist of? We are a case study-based program. Everything we do is based on case studies. We've learned everything we have learned from other entrepreneurs who have done it before, and we have synthesized and made it accessible for you so that you can stand on the shoulders of people who have done it before. This includes several hundred unicorn companies and lots of bootstrap companies, lots of venture-funded companies, many hundred bootstrap companies, many hundred venture-funded companies. The policy for investor introductions is also laid out clearly on the website. Our methodology is bootstrap first, raise money later. You heard Bunny say earlier that you're going to need to show some customer engagement, some amount of, validation from customers. So bootstrap first, raise money later works, and that's what we follow. That's pretty much it. We have, roundtables coming up, August 26th, September 2nd, 9th, 16th, all are roundtables. If you have questions, I'll answer them. Otherwise, we're going to adjourn a little bit early today. I have something else. Anybody, questions, comments, introductions? If you have questions about the program, you can contact Irina at 1M by1M.com. She will answer any and all questions. She's been with the program right through. Anybody? All right. Well, I'm going to adjourn for today. Thank you for coming, and we'll see you soon. Bye.